Okay, let's finish our look at the secret decoder ring or our transaction template. And so um, here we have the final three categories, right? We have our purchases, cash payments, and these other miscellaneous kinds of transactions. And so let's take a look at the first ones. And um, the first setup we had is if we purchase some investments, we could pay cash, okay, which would reduce our cash. But we can also pay it on credit or buy it on credit. So you'll see investments increase, cash can go down. If we had some sort of credit associated with it, then our liabilities would increase. So there is the rub when it comes to thinking about debits and credits. On the asset side, I always thought it was a little more clear. So a debit always increases my assets. Credit will always reduce my assets. Over here on the liability side, credits always increase my liabilities, increase my obligations, and debits bring those things down. Okay, so those are they're certainly mirror images of each other, and it sometimes gets even a little more confusing when you get over here into the equity side of the house. But we'll get there. All right. Inventory, inventories increase. They're almost always a customer will give us some sort of credit to make that happen. Uh, Again, I could pay cash for this. I could pay cash for this, but more likely, when I increase these two, these categories, I'm going to have some sort of debt obligation associated with it. It might be a current amount that I have to pay or soon, or it could be something the long-term debt (LTD), long-term debt that I put together with my bank or other financial institution where they loan me money so I can buy some equipment. Cash payments, all cash payments are going to reduce the cash, and so uh, if I if I'm paying off my accounts payable, cash goes down. In this case, we got a debit over here in accounts payable, so that's going to drive it down. Okay, we've got payments for payroll taxes, payroll, other things, all of that. We can pay cash. Uh, um, we'll take care of those obligations that way. We can pay for borrowings. We can pay for this thing called treasury stock. So it's going to affect us over here. And finally, we could pay out dividends, and that's going to affect us over here. Then we have those things that are non-cash. Note that cash is unaffected by these, just like it was unaffected probably by the purchase of inventory. In this case, inventory movement, it can go actually at a debit or a credit. So it's the weirdest one of all those, but ultimately it can wind up here when I actually sell my products. Um, my inventory can turn into an expense or a cost. And we'll call that cost of sales. Uh, and here's the other one, depreciation. All right. And so in this case, it will reduce property, plant, and equipment. And more than likely, it's going to wind up here in some sort of expense. You'll note that I have this strange little random debit over here. We'll do that later in class because it has to do with the cost of inventory. And I'm not working with that right now. We're just trying to get the basics. So that's what we have as our setup. Purchases, they generally have a theme. Okay. Most of them are just going to affect accounts payable because most of these as they say, on account. Somebody's extending credit to us. Then we got the cash payments, where all of these are going to reduce our cash, but they're also going to reduce a liability probably as well. Or that last case, it's paying out some dividends. Then we have these other kind of miscellaneous ones, uh, very accounting-esque in a sense. And so, but they are non-cash. So these are the ones that don't affect us from a cash standpoint, but that certainly affects us in terms of how we interpret our information, certainly affects us from a tax standpoint. And so let's tie this thing up and uh, go back to what we'd originally talked about in one of our early slides, cash flow. And so if we believe that cash is the center of our universe, boy, that's very materialistic. But nonetheless, uh, how do you get it? We have the cash receipts transactions and sales to customers. How do you use it? Okay, cash payments. How do I keep it? Use somebody else's cash. So that's the liability side. If I can make use of somebody else's uh, cash or willingness to allow me to buy things on credit, I'm keeping my cash for a while. But in the end, these transactions all come back to the cash piece and say, all right, eventually the idea is how do I turn my operations into cash? And that ultimately is a question of liquidity. And with that, we have finished module 2 and hinted at a few other things, but that's where we're going to stop for now. And it's important at this point that you dig into the problems that we'll provide in my podcast videos, because there, instead of this kind of theoretical view, you can actually put some numbers to this discussion that we're having. So with that, thanks for hanging in there with us. I hope you found it informative, and I will talk to you again soon. So take care. And as always, goodbye for now. Bye.